Learning Objective 12-6. Make calculations and remeasure financial statements of a foreign subsidiary. So, remeasurement is another approach towards converting a company's financial statements from one currency to another. We've already gone over translation, and remeasurement is a different way to do this. And you're probably wondering, well, then why do there need to be two different ways? Again, to go over this, translation would be used when you're converting from one functional currency to another. So if the subsidiary uses one functional currency and the parent is using another functional currency, translation would be used to convert from the subsidiary's functional currency into the parent's functional currency. Remeasurement happens when the subsidiary is not keeping its books in its functional currency. So you may have a situation, let's say you have a subsidiary in England whose functional currency is the euro. And they keep their books in pounds. So what they would need to do is they would need to remeasure the financial statements into euros. And so, again, we're converting here, but the exchange rates that we're going to use are going to be quite different. A key to understanding this is to understand the idea of monetary versus non-monetary assets and liabilities. Monetary assets and liabilities have a fixed amount in terms of what they're denominated in. So, for example, cash will say how much cash there is, of course, and that's how much cash there is. Accounts receivable, accounts payable, notes receivable, notes payable, all these kinds of things are monetary assets because they are denominated with a certain amount of currency. Non-monetary assets are everything else, and here you can see a list of what they are. It's a good explanation of the difference is debt securities. Debt securities to be held to maturity are monetary because you're going to receive a certain amount of money when they mature. But if they're not intended to be held until maturity, then their value really depends on market value, which is not monetary because it's changing all the time, and therefore it's considered to be non-monetary. So these are all examples of non-monetary assets and liabilities. They would be recorded at, what we'll go into in a moment, at historic rates. And here you can see the rates themselves. In the balance sheet, monetary accounts will be converted over at the current rate. Non-monetary accounts are converted at what's called the historical rate. What you would do is you would look and see when the account originated, what was the rate on that date, and convert it on that date. For example, if you bought a fixed asset on a certain date, fixed asset is non-monetary, you would record it at its historical cost, and then you would convert it at the current rate on the date, the spot rate, on the date that you bought the asset. And most revenues and expenses are going to go at average rates or weighted average rates. Weighted average because sometimes you have more transactions on some days than others. For example, if you do a lot of business in one particular quarter, or 1 month, then you would want to weight the rate in that month more heavily than the rate in other months. And how you do PP&E and depreciation, along with intangible assets and amortization, need to be recreated at historical rates. So, for example, with PP&E, what you would do is you would convert the PP&E over at its historical rate, but you would also use the historical rate to set the depreciation. And you're going to do the same thing for intangible assets. Cost of goods sold is, I like it. I think it's pretty cool how cost of goods sold goes. It follows this format that I like, that sort of rolls the balance forward, keeping track of the functional currency and the US value. What you would do here is, this here is, actually this is not quite accurate how they did the columns. This would be the book rate. This would not be functional currency, I don't think. this would be whatever they kept their original currency, and this would be the functional currency here, is how this would be done. What they call the recording currency. And then the rate would be and the functional currency. And what you would do is you would record the beginning inventory at the beginning at its and convert it the historic rate, convert the purchases at the average rate to get the goods available for sale. You subtract inventory at the historic rates. In other words, you'd have to figure out, you have a certain amount of ending inventory. What was the rate of exchange on the days that you bought that inventory? It's going to be affected by LIFO and FIFO. And then you'll get the cost of goods sold. You're going to do something similar with retained earnings. And again, this is not quite accurate, because this is going to be the recording currency. And this is going to be the functional currency. They're just assuming that the functional currency is the US dollar, but it's inaccurate to put the functional currency in the left column here. And so what you're doing here is you're trying to, and this is the common sense behind everything that we're doing, produce the same end result as if you had been initially recording everything in the functional currency in the first place. So you've got to you're basically reconstructing the financial statements into the functional currency. And that's a big job, but it's just logic. It should just make sense. And if you go through it enough, you begin to see that it's kind of like they should have used the functional currency all along, but they didn't. Now, why wouldn't they use the functional currency, right? You're probably wondering that. They wouldn't use the functional currency. My theory is the reason why this happens is because of regulatory requirements. So, for example, they may have a business in England, in the UK, where the local currency is the pound, but they've determined the functional currency is the euro, because they do most of their business with the European Union. British laws may say you have to keep your records in pounds because that's our currency. We're going to tax you, and we're going to tax you in pounds. So it may be a regulation, I don't even know, in UK that you have to keep your books in pounds, even though your functional currency may be something else. In which case, you would have to do a remeasurement from British pounds into the euro. And your gains and losses on remeasurement are going to be gains or losses that go to the income statement. And it said it right here, I think. This is extremely important. I'll tell you honestly, I've put this on many old quizzes. You'll see it in old quizzes. And I would say a third of students get it wrong. Translation gains or losses go to other comprehensive income. Remeasurement gains or losses go straight to net income. And that's a very important distinction. The reason why is because the company's been using the local currency all this time and not recording gains or losses on foreign exchange transactions. And when they remeasure, all those foreign exchange gains or losses pop right out, and they have to go to income, just like any other gains or losses on foreign exchange transactions. I believe this is the same example that we did before. And you can see here, there's one new piece of information here, and that's that ending inventory is at FIFO, and it was acquired when the exchange rate was $1.38. So when you're going to convert these financial statements over in a remeasurement, what you're going to do is you're going to need to use the current rate on all the monetary assets and liabilities. So the current rate here is going to be $1.40. Receivables is also a monetary asset. Accounts payable is also a monetary asset, as is bonds payable. So these are your current assets. These use the current rate. These are your monetary assets. Inventory is going to go at the historic rate, which in this case was $1.38. Plant and equipment would go at the historic rate. We bought the whole company on January 1st, 2021. So that was $1.20 at the time. And since plant and equipment is $1.20, then accumulated depreciation is also going to be $1.20. I'm going to skip cost of goods sold for a minute. Operating expenses is going to go at an average rate, as will sales go at an average rate. Common stock will go at the historic rate, which is $1.20. That's when we bought the company. And retained earnings, for the same reason as I gave you before, is going to go at the historic rate. The foreign currency transaction loss, you're probably thinking it could go at the date of the transaction. It's an expense like any other, and it's going to go at the average rate. The dividends paid, on the other hand, needs to go on the date of the dividend and be $1.36. So that leaves us with cost of goods sold. And we'll do, here, they're going to adjust operating expense because operating expenses include some depreciation. So let's take that back out again. Cost of goods sold, we got to go back to see what beginning inventory was. So I'm going to go back to my translation template here, all the way, way back. And back then, my inventory was 7,500. So that would be my beginning inventory. And that would translate at $1.20. Or $9,000. And then, you know what? I don't know purchases. But I know my cost of goods sold was $22,500. And I know my ending inventory is $5,000. So from that, I can figure out that the purchases is $20,000. Because it'd be 22,500 minus 7,500 minus a negative 5,000. You could do a formula beginning in, so you could just plug it into this formula. Cost of goods sold equals beginning inventory plus purchases minus ending inventory. You can plug it in there and you'll get $20,000 in case you're wondering. So the rate of interest on purchases is as purchases were purchased evenly throughout the year, so that would be $1.30. Ending inventory, we know, was at $1.38. So purchases in dollars would be 20,000 times $1.30. Ending inventory would be negative 5,000 times $1.38. And it would come out to be in dollars, if we had been using dollars all along, $28,100. So that's going to be cost of goods sold. There's no one exchange rate for that. I rather have to figure out cost of goods sold by plugging in what the exchange rates were, pretty much reconstructing what would have happened with cost of goods sold. Operating expenses, I think they're just like giving you a hard time here. Operating expenses was $14,500, and we got to figure out how much of that is depreciation and how much of it is cash. Accumulated depreciation, 7,500 euros. At the end of the year, at the beginning of the year, accumulated depreciation was 5,000 euros. So of this, 2,500 is depreciation expense, and the remainder is cash expenses. So depreciation expense would be converted at the historic rate of $1.20, whereas the rest of the cash expenses are going to convert at an average rate of $1.30. Because depreciation is related to PP&E, so it's got to go at the historic rate. And therefore, my total operating expenses converted would be $18,600. And now let's multiply everything across. And I get debits of 156,700, and I get credits of 155,700. So that would mean the plug there would be $1,000. That would be your remeasurement gain. And that's not going to go to OCI. That's going to go to the income statement. We'll see how it will in a moment. Now, the book goes through a proof of translation adjustment. I'm going to spare you that just because there's a lot of steps to it. I think it might be in a homework or not. I don't think it's the most important thing, but it's something to be aware of. And it's something that if you have the book open, you should know how to do. There's a lot of steps to it. I don't expect you to spend a lot of time on it, but you might want to know it for the homework. The proof of translation adjustment assures you that, gives you some assurance on this $1,000 figure. Because any one of these rates, if it's wrong, could throw this number off and then give you the wrong answer. So the proof of translation, proof of remeasurement adjustment helps give you some assurance that that's accurate.